Fabio, you're part of what authored this report that certainly had urged regulators, authorities to be paying more attention. What is the chief concern?
Great to be here, first of all. The concern is one of rapid growth, right? So this is part of a trend that has been going on for decades from public to private markets, and there are certainly benefits, including for borrowers as well as for investors, but there are also vulnerabilities and possible risk. So we highlight one that has to do with the more risky borrowers. So those are smaller firms with more leverage, for example, or risk related to the liquidity mismatch between the assets and liabilities. That liquidity mismatch is less of a concern in this fund because they have very long committed capital, but there's a growing size going market to retail, for example. Leverage, it's another vulnerability, it's layers of leverage in the system. So this is the point, in case of like a prolonged economic downturn, we just have no idea how the system would operate.
I will be curious about that layer of leverage that you're finding, how many exactly there are, but I'm also curious, on the very surface here, just how much of a force is private credit becoming in the economy?
So the sector is a significant source of credit at this point. So it represents about 7% of the overall credit non-financial sector, and it's about 10% of bank credit. So it's the size that is relevant now, but also how rapidly it has grown, right? This is why we decided to focus on this sector. They are an important source of credit for firms. They are also an important source of returns for investors, right? Including like institutional investors. And so that's the reason why we look into this sector.
Now, there is some language here that I'm very curious about, this idea of potential systemic risks that could be created. You don't say that it is posing one now, per se, but what future worries do you have down the road?
So I think the two main concerns here, one is the interconnectedness, right? So in this ecosystem of private credit, we have not just private credit funds and other structures like BDCs. We have insurance companies as investors, but also we have private equity, and the link between private equity and insurance company, it's a growing feature in market, as well as the role that banks play. Banks are one of the providers of credit to this sector. So is this the link between the funds, the private equity, insurance companies, and banks, in a world where we really don't have much data to use for assessing and monitoring this risk?
Now, is the problem for the funds themselves or for the impact it could have on the economy if something were to go wrong? We were just talking about leverage. Is the implication here that there's a lot more leverage than meets the eye?
So we don't have data, first of all. So the entire report is based on public data. So there is some leverage that banks provided. The Fed estimated that to be around 200 billion. If you include derivatives, it's another 200. There is the leverage at the borrower level, and then there's the leverage that the investor themselves may use. So this is the layering of risk that we're trying to emphasize. I don't know, we have no idea in a prolonged distress environment how the deleveraging would play out, how these layers of leverage would work out in the end.
Now, how do you think about the implications, not just for the economy or for regulators, but for investors? You kind of spoke a little earlier about how more retail investors are entering the space. The liquidity profile changes quite drastically in many of those vehicles.
Right. So for the private credit funds with institutional investors, those are like locked up capital for many years. So there is less of a liquidity concern there, mismatch. Retail is a little different, right? So they can withdraw money at a quarterly basis, for example. There are gates. So there are liquidity management tools. What is not clear is, given how the sector is still relatively opaque, what are the expectations of retail investors going into this investment? Like, do they expect that they can really only get money a quarter or have different expectations?
How do you think about this at the IMF in regard to how banks are stepping back from the global economy? You're seeing regulation really starting to increase in many continents at this point. You also have seen many crunches from the banking systems for other reasons, maybe provisions for loan losses or otherwise, as there are worries still about the economy. Where does private credit play a role in the future, knowing those constraints have existed and will exist?
So there is, I think, a benefit, which is the differentiation of funding structure. Right? The fact that the credit is not in one segment of the financial system, that should, in principle, reduce the financial stability risk. On the other hand, they're starting to play a significant role. And if you are moving in a world where there will be more regulation, for example, coming for banks going forward, then this sector is growing this fast, is growing, so it will play an important role for credit provision. And so that is, I think, the linkage that we are concerned about.
And to be fair, there is still really a warning here. It's balanced, but there is a warning that there could be liquidity risks down the road. If the economy were to seize up at this point and you have private credit playing an increasing role, what does that mean for borrowers?
Right, so Usually, the counterfactual that is offered is COVID, right? During COVID, that sector was still there for business, was providing credit, was providing financial services and liquidity. Now, that said, there was a relatively short period of stress. There was not a prolonged recession, and the Federal Reserve stepped in, backstopping the broader market. So the concern is that you get a prolonged recession. Some of these valuations are stale, so it might not be immediately mark to market, but if it happens at some point, and then you start seeing liquidity pressure, right? For example, investors that want to take money out of some instruments, or companies that take down their lines of credit there with private credit. Those are the liquidity stress that we have not seen in a prolonged contraction environment.
Liquidity stress and credit stress. I want to read part of your own report, this idea that because the sector has so rapidly grown, it never experienced a severe downturn at its current size and scope, and many features designed to mitigate risk have not yet been tested. The current regulatory requirements for insurers and pension funds do not consider the credit performance of the underlying loans. We at Bloomberg have reported a lot on the valuation disparities. How much do you worry about the underwriting here alone, the credit quality?
So the point of there is that we have seen for both insurance and pension, particularly insurance company linked to private equity, the share of illiquid asset, or what we call level 3 asset, it's larger 3 times, for example, than those that are not linked to private equity.
That's a pretty stunning amount.
So you go from 7 to 20%. So it's a very large difference between the two. And so that is the concern. We are also focusing on the link between the private equity and the insurance company themselves. So that could be another issue of interconnectedness. In terms of the valuation, the issue is that there is no visibility. They're quite opaque. So there are some indices that you can use out there, but they only represent a subset of the market. We have no idea how this pricing would work, again, in a prolonged recession.
So what here is the recommendation? When you speak to regulators, when you speak to authorities, what now?
I think one is data. You need to close the data gap. There are too many data gaps out there. There are information for specific segment. I think what is missing is a system-wide view, right? Ability to assess what are the interconnectedness. Again, banks, insurance company, private equity, there's no data there. Another one is to have a more intrusive supervisory approach to this. I think there is really a need to look into this and monitor more. There is also the retail that I mentioned before. So I think the bar for transparency is higher once retail investors are involved. And then finally, which is often overlooked, there are cross-border implications. US credit funds are an important share of credit of the fund provided to these instruments in Europe. There's very few people that have the ability to look at cross-border implications. That's where the FSB, the Financial Stability Board, I think can play an important role.